All right, let's pull back the curtain on the stock market. But we're not going to talk about the usual stuff, charts and news. Nope. Today, we are going deep, deep into the operational heart of it all. We're heading into the engine room.
I mean, think about it. You see a stock you like, you punch in the number of shares, you click that buy button, and poof, a second later, you own a piece of a company. It feels instantaneous, almost like magic. But what's the actual machinery humming away behind that simple click? You're about to step into what people in the know call the engine room. This is where your click gets turned into a real thing, going on this incredible high-speed journey through 3 different departments: the front, the middle, and the back office. So let's follow your order and see exactly what happens. And our journey starts right here, in the front office. You can think of this as the front door, the main lobby. It's the very first point of contact, where you and your order get introduced to the entire market system. But before you can even place a trade, you've got to get the keys to the gate. That's the onboarding process. It starts with KYC, which just stands for Know Your Client. Basically, they collect your details. Then that info gets uploaded to a central agency called the KRA, which is great because it means you don't have to do this over and over with every single broker. And finally, you get a UCC, a unique client code. That's going to be your digital fingerprint for every trade you ever make. Now, here's something that's changed recently, and it is a huge deal for investor protection. The old way involved signing a power of attorney, which kind of gave your broker really broad control over your shares. Well, regulators swapped that out for something called DDPI. All you need to know is this: the new way gives brokers very specific, very limited permission. It protects your assets from being misused. Honestly, it's a massive win for you, the investor. Okay, so you're in. You're ready to place an order. But turns out there are different flavors of orders. A market order basically screams, "I want in now, I don't care about the exact price." A limit order is the opposite. It says, "I'm only buying at this price or better." A stop loss is your safety net. It's a defensive move to get you out if the price drops. And an IOC order? That one's for when you just want to grab whatever's available at that exact moment and cancel the rest. So with all these orders flying around, how does the exchange decide who gets what? Well, it follows one simple, beautiful rule: price, time priority. Price always comes first. The person willing to pay the most or sell for the least gets to the front of the line. If, and only if, 2 orders are at the same price, then time matters. The one that got there first wins. That's it. That's the golden rule for the entire market. So, you've placed your order. It instantly gets zapped into the middle office. Think of this place as the control tower. Its entire job is to spot and manage risk, and it does it in a fraction of a second. Before your order can even sniff the actual market, it has to run a gauntlet of instant risk checks. First up, margin check. Simple question: you got the money for this? Second, an order value limit check, just to make sure the order isn't ridiculously large. And third, dynamic price bands. This one's a lifesaver. It stops those fat finger errors, like accidentally typing in 2,000 for a stock that's trading at 200. Now, the control tower isn't just watching you, it's watching the entire brokerage firm. And there is one number, one critical number it's always watching. And that number is 90%. So what happens when a broker hits it? Well, it triggers the system's big red panic button, risk reduction mode, or RMRM. If a brokerage firm uses up 90% of the collateral they've parked with the exchange, the system partially freezes them. No new risky bets allowed. They can only place orders that reduce their existing risk. This is an absolutely crucial circuit breaker that stops one broker's big mistake from turning into a market-wide meltdown. So, your order passed all the risk checks, it went to the exchange, it got executed. Amazing. The journey's almost over. Now we head to the final stop, the back office. This is where the deal is officially sealed, the final handshake happens, and the most important piece of paper, or, PDF, that comes out of here is the contract note. Now listen, this is not just a receipt. This is a legally enforceable confirmation of your trade. Brokers are required by law to send this to you within 24 hours. It lays out every single detail: price, fees, taxes. It's your ultimate proof. And you won't believe how fast this all gets wrapped up. India runs on a super fast T+1 cycle. So on T-Day, the day of the trade, the deal's done. By the very next day, T+1, the broker sends the money, the clearinghouse pays the seller, and by 3:30 in the afternoon, boom, the shares are sitting safe and sound in the buyer's demat account. It is an incredibly efficient system. And here's another key safety upgrade for you. It used to be that the shares went to the broker's account first and then to you. Not anymore. Now, the clearing corporation deposits them directly into your personal DMAT account, completely bypassing the broker. It's another one of those small changes that just removes a layer of risk and makes the whole system safer for you.
So we've seen the whole assembly line, right? Front office, middle office, back office. But why does understanding this engine room actually matter? Well, let's look at a couple of real-world situations to see it in action. So imagine this. A client calls their broker, totally freaking out, saying, "Hey, there's a trade in my account and I swear I never placed it." That's a serious problem. What's the very first thing the brokerage is going to pull up to defend itself? You got it. It's the contract note. That document from the back office we were just talking about. If that broker can show that the note was generated and sent within that 24-hour window, it stands up as powerful, legally binding proof that the trade was official. See? This is why that boring back office stuff is so important. Okay, one final pop quiz. Let's go back to that golden rule. An order comes in to buy a stock for 100 rupees at 10 a.m. sharp. 5 minutes later, another order for this same stock comes in, but this person is willing to pay 101. Which one gets priority from the matching engine? It's the order for 101, every single time. And why? Because of the golden rule. Price, time, priority. Price is king. A higher bid is a better price, so it automatically jumps to the front of the line, even though it showed up 5 minutes late. Time only comes into play when the prices are exactly the same. So there you have it, the entire invisible, high-speed journey your trade takes, from your screen through all those risk checks, onto the exchange floor, and finally settling in your account. The next time you go to click buy, maybe you won't just see a button anymore. Maybe you'll see that entire incredible engine whirring to life just for you. Thanks for coming along for the ride.